Is Indonesia staring at a financial miracle? Or maybe a catastrophic collapse?
It's a real knife-edge situation, honestly.
Welcome to Meridian. We track the high-stakes plays in the global economy. Hit that like, hit subscribe, because today we're diving into one seriously thrilling fiscal story.
Yeah, it really is like a tightrope walk.
Yeah.
The data, well, it paints two very different pictures. Indonesia's national debt. It's climbing, quietly, but climbing.
Some call it strategic investment, necessary even.
And others, they see a ticking time bomb.
Okay, let's cut right to it. On the surface, things seem manageable. Indonesia's government debt-to-GDP ratio is set to rise from, what, just under 40% now to maybe 42% by 2029?
Right.
That's way below their own legal limit of 60%. So sounds pretty prudent, doesn't it?
Prudent is one word. But here's the catch, I think. This isn't just a temporary spike like after a crisis. It's a persistent upward trend, a structural creep, meaning state spending is just consistently outpacing what they bring in through revenue, year after year. And that slowly, surely eats away at their fiscal space. Their flexibility is shrinking.
But hang on, the big rating agencies, Fitch, Moody's, S&P, they seem fine with it. They're all holding steady with BBB or Batu ratings, stable outlook. The gatekeepers of capital aren't panicking.
That's the official line, yes. But the market, the actual buying and selling, the real-time sentiment, that's telling a more nervous story.
How so?
Look at the 5-year credit default swap premium. Basically, the cost to insure against Indonesia defaulting. Between January and April 2025, it surged, up over 51%.
51%? Wow.
Exactly. From about 75 basis points to over 113.
Yeah.
That's the market pricing in new risk, serious risk. It's a real disconnect from those stable ratings.
So where's this anxiety bubbling up from? Let's talk the 2025 budget, the APBN, a planned deficit of over 600 trillion rupiah.
Yeah, about 2.5% of GDP.
They frame it as a necessary expansion, funding big infrastructure like the new capital city, IKN, smart investments for future growth.
That's the argument. But are they really investments?
Yeah.
Or are they?
Tricks.
Look closer. Tax collection, first quarter 2025, only hit about 15% of the target.
Ouch.
And tax revenue actually contracted year on year through May by over 7%.
Yeah.
The revenue engine is sputtering.
Okay, that's not great.
Then add the energy subsidies. Nearly 400 trillion rupiah earmarked for 2025. But here's the kicker. Over 70% of that money, it goes to wealthier households. It's a massive drain, not really a productive use of funds.
What about new programs like the Free Nutritious Meal Initiative? That sounds like it's aimed at welfare.
It starts at 71 trillion rupiah. But if they roll it out fully, estimates go up to 460 trillion rupiah annually. That's huge. We're talking 2% of GDP.
2%. That's comparable to their entire education budget.
Precisely. It's a major fiscal trade-off. Pouring money into consumption, maybe not long-term growth drivers. And don't forget the debt servicing costs themselves.
Right, paying the interest on existing debt.
Over 550 trillion rupiah planned for 2025.
Yeah.
That could eat up nearly 19% of state revenue. Just dead weight, diverting funds that could go into, say, healthcare or infrastructure.
Okay, but let's shift gears. What about Hilirisasi, the downstreaming policy, turning raw materials into finished goods? Nickel exports exploded.
It did. From about $3 billion in 2017 to nearly $34 billion in 2022. Huge jump. Looks great on the surface.
So transforming Indonesia into a value-added player, that's a clear win, isn't it?
It looks like a win, but you have to ask, who is really winning? The benefits seem highly concentrated, a lot of the profits, reportedly repatriated often to the Chinese firms running the smelters. And then there are the massive environmental costs, very carbon intensive, there's pollution. So is Indonesia really the main beneficiary here? It's a complex picture.
Okay, what about the other big projects, the National Strategic Projects, PSN, and the new capital, IKN? They're aiming for 80% private funding there. That limits state exposure, surely.
That's the goal. But private investment in IKN, it's been slow to materialize. So the state budget ends up carrying more weight than planned, like 4 trillion rupiah from the Public Works Ministry just for IKN in 2025. And this brings up the elephant in the room, the state-owned construction companies, the BUMN Karya, firms like Waskita Karya, huge liabilities, recurring losses. We're talking nearly 70 trillion rupiah in liabilities for Waskita alone.
So they're struggling financially.
Big time. And their distress. It becomes a potential or contingent liability for the government, a hidden debt, a ticking bailout bomb, really.
Right. Still, that headline debt-to-GDP number around 40%. It looks so much better than neighbors like Malaysia or Thailand or the Philippines, all much higher. Doesn't that give Indonesia some breathing room? Make it look strong?
It looks strong, yes.
Ugh.
It's a deceptively safe comparison. But here's the crucial thing people miss.
Hmm.
It's not just the amount of debt, it's the nature of the debt that matters.
Explain.
Look at Singapore. People point to it all the time. Their debt to GDP is massive, like 175%. But they have a top-tier AAA rating. Why?
Good question.
Because Singapore borrows to build its capital markets, to back its pension funds, the proceeds. They're invested through sovereign wealth funds like Temasek, huge assets. Singapore has zero net debt. They are a net creditor.
Okay, I see.
Indonesia, on the other hand, largely borrows to fund current spending and plug budget gaps. It's a fundamentally different, and I'd argue, much riskier proposition.
So beyond the state finances, what about the social side? Are these programs actually improving welfare across the board?
We're seeing some worrying signs, actually. The Gini ratio, which measures inequality, it ticked up slightly recently, from 0.379 to 0.381.
Not a huge jump, but the wrong direction.
Exactly. It suggests middle-class purchasing power might be weakening. And then there's the huge debt forgiveness program for small businesses, UMKM, 10 trillion rupiah, a million debtors.
Helping small businesses sounds good.
It's a fiscal band-aid.
Yeah.
Necessary, maybe, in the short term, but it creates what economists call moral hazard. It might signal that debts don't always need to be repaid, which can cause problems down the line.
So putting it all together, is Indonesia on a path to pay off with these calculated gambles? Or is this tightrope walk getting, well, dangerously wobbly? It definitely feels like a financial thriller unfolding.
Look, it really boils down to discipline, fiscal discipline, serious structural reform, and let's be honest, probably a bit of good luck too. The margin for error is getting thinner, much thinner.
A shrinking margin for error. So what do you think? Is Indonesia playing its cards right, or is the risk just too high? Let us know your take down in the comments.
Yeah, we'd love to hear your perspective.
And don't forget to hit like and subscribe to Meridian for more deep dives into these high-stakes economic stories. Thanks for joining us.
If you want more no-nonsense stories about power, money, and the systems behind them, subscribe to Meridian channel.